This chapter is designed to introduce you to stocks and stock valuation. It's not going to make you an expert on stocks. You're not going to become a multi-millionaire Wall Street pro after this. However, it should get you familiar with what things cause stock prices to go up and down, how to do some basic stock valuation, and create a foundation for understanding how stocks are valued in the financial marketplace. We're also going to talk about some characteristics of stocks, such as par versus book versus market value, and what are some of the characteristics associated with stocks, rights that you get, such as the right to residual income, right to information, and so on. We're also going to introduce an important topic called market efficiency and talk about what that means and the implications of market efficiency to investors. Let's start by talking a little bit about valuation. In this chapter, we're going to use that same three-step valuation process that we introduced last chapter when we were talking about bonds. Just as a reminder, step 1, forecast all the expected cash flows throughout the life of the security. Step 2, choose an appropriate discount rate. And step 3, solve for present value. However, there are going to be a couple of twists here. One of the big differences is that the cash flow stream is infinite and variable. Remember, when we were dealing with bonds, we had a fixed cash flow stream, coupon payments, every 6 months throughout the life of the bond, and then the par value returned at the end of the bond's maturity. So a fixed cash flow stream, and it was also a finite time horizon. The bond had a set maturity date. It would pay those coupon payments until that maturity date, and then it would return the par value to investors. Stocks are very different. Stocks pay dividends. Dividends can go up, dividends can go down. Companies that hadn't previously paid dividends can initiate them. Companies that have been paying dividends can decide to stop paying them. So with a dividend stream, we have a variable cash flow stream. It can go up or down, and we don't know exactly what it's going to do. We can try to forecast it, and we are going to do that in our models, but we don't know what it's going to do. Another thing is that stocks have an infinite time horizon. There is no maturity date for a stock. Instead, that stock is going to continue to exist and continue, hopefully, to pay dividends until either the company goes bankrupt or until the company goes private. So something is going to have to happen to cease trading in that stock. Otherwise, it's going to keep having that cash flow stream. Now, this makes things a lot more difficult. When we had bonds, it was very easy to predict that cash flow stream. When we have stocks, it becomes very difficult. So step 1, forecast all the expected cash flows that the security is going to pay throughout its lifetime, becomes a big guessing game with stocks. We have to guess what those dividends are going to be, and there's no ending date, so we have to keep guessing forever. We also need to do step 2, choose the appropriate discount rate. Remember from chapter 1 that stocks were riskier than bonds. Riskier investments mean that they should generate higher returns on average. So the discount rate, or the required return associated with the cash flow stream for stocks, will typically be higher than the required return for bonds. Now, there might be some exceptions. You might have a bond of a company that is really struggling, on the verge of bankruptcy, that would have a high required return, very risky because there's a good chance it's going to go bankrupt. And you might have a stock of a company like Pepsi or a Walmart, which is a very stable company. And you could imagine a situation where if you have a bond of a junk bond, that it might have a higher required return than an extremely safe conservative stock. But on average, discount rates for stocks are going to be higher than discount rates for bonds. Now, when we talked about estimating the required return or discount rate for bonds, we said that that was going to be largely subjective, based on things like the risk associated with that bond and inflation that was expected to occur over the life of the bond. Stocks, there are a couple of ways to do that. One, you can rely on the same subjective approach, try to figure out what inflation you need in order to maintain your purchasing power, and then a risk premium on top of that. Also, something that we're not going to use in this chapter, but we will see show up later on in Chapter 7, is something called the security market line. And the security market line is a tool for estimating the required return. But as far as this chapter goes, that discount rate or required return for stocks is just going to be given as part of the problem. In real life, that's one of the challenges that you have, is figuring out what an appropriate discount rate should be. Then our last step, solving for the present value of the cash flow stream, is going to be a little bit more difficult. Remember, in bonds, we could just apply the 5 key approach because we had an annuity stream, which was our coupon payments. We had a future value, which was the par value that got returned to us at maturity. We knew how many periods, so we had the N, and we had our discount rate. All we had to do is then solve for present value. Because stocks have a variable and infinite time horizon, then we run into a problem with the 5 key approach. If it was just a variable cash flow stream but finite, we could use our cash flow worksheet. But our cash flow worksheet requires us to have a stopping point somewhere. And so we can't plug a variable and infinite cash flow stream into our financial calculators. So we're going to have to rely on some shortcuts. We're going to make assumptions about growth rates, and that's going to allow us to use some formulas or some other shortcut processes to try to solve for the present value of that cash flow stream. Key takeaway here, though, is that stocks are a lot more difficult to value than bonds. Trying to come up with what a stock is worth is an extremely challenging process, and that is why you can have 10 different professional investors, people that do this for a living, look at the same company and come up with very different levels for what they believe the stock is worth. No one knows exactly what a stock is worth. We're just trying to make these estimates based on what we think is going to happen to the cash flow stream and what we think an appropriate discount rate should be. Now, when we get into our stock valuation models, we're going to use 3 basic models. The first, which will normally be applied to preferred stock, but you could possibly use in a common stock situation, is no growth. That just means the dividend today is going to be the same as the dividend next year, and the year after that, and the year after that. So effectively, we're eliminating the variable nature of the cash flow stream. We're saying that the same dividend is going to be paid every year throughout the life of the stock. That's going to make it a perpetuity. So we're going to use the same perpetuity formula that we saw back in Chapter 3 on time value of money. Another model that gets a little more realistic, companies tend to grow over time, so no growth does not work well for most common stock. Actually does work pretty well for preferred stock, but normally in common stock the no growth model is not appropriate. Companies tend to grow over time. So we introduce a constant growth model, which as long as we assume dividends are going to grow at the same rate every year forever, then we can come up with a simple formula. Now, hopefully you notice the catch there. If we assume dividends are going to grow at the same rate every year forever, how realistic do you think that is? Do companies grow at the same rate every year over time? No. Sometimes they grow faster, sometimes they grow slower. Companies may be in a huge expansion stage. The economy may slow down. Lots of things are going to affect growth rates. So the constant growth model is an approximation that may be a reasonable approximation in some cases, may be a very poor approximation in other cases. So we need another model. This is our most realistic model, and that's the non-constant, or sometimes referred to as the supernormal growth model, and that allows us to estimate growth rates year by year out for a while into the future. Now, we can't do this forever, so we can't continue to estimate individual growth rates in year 987 and year 988 and so on. So we can only estimate individual growth rates for a certain number of years, but that gets us a little more realism into our models. Now let's talk about some general information on stocks. One of the things I want to stress here is that normally when you hear people talk about stock, they're referring to common stock. We're going to talk about both common and preferred in this chapter, but in general, when you hear people say, I invested in stock, or hey, what's Walmart stock worth? They're typically talking about common stock. The name itself is very appropriate, common. It's far more common than preferred stock. Relatively few firms issue preferred stock, so 95% of the time when you hear people talk about investing in stock, they're talking about investing in common stock. Preferred stock is kind of a hybrid security, combines some of the characteristics of common stock and some of the characteristics of bonds. For example, preferred stock pays dividends like a stock. What that means is if the company does not pay that dividend, investors can't force them into bankruptcy. Remember, coupon payments on bonds are promised payments. If the bond does not, or if the company does not make that payment to the bondholders, the investors, the bondholders, can declare bankruptcy and force the company into bankruptcy. Dividends, on the other hand, are not coupon payments. They're not an obligation of the firm. So preferred stock pays dividends means those dividends are not an obligation. If the company runs into financial problems, they can stop paying them. That means preferred stock is a little riskier than bonds. However, the dividends have to be paid to preferred stockholders before any dividends can be paid to common stockholders. So that makes preferred stock a little safer than common stock because they're going to get paid first before the common stockholders are. Typically, preferred stock has no voting rights. We're going to talk a little bit more about voting rights later on as we move through the chapter, but quite often preferred stock is not considered a voting ownership interest like common stock. That gives it more characteristics of a bond. Also, preferred stock in bankruptcy claim is going to come between bonds and common stock. Bonds have a higher priority of claims. They're going to get paid first. Common stock is going to get paid last after the preferred stockholders and bondholders have been paid. Now, the name preferred does not mean it's a better choice. It doesn't mean that, hey, I'm going to own preferred stock because it's better than common stock. Instead, preferred stock just means it's paid earlier in that priority of claim. So that's where the name preferred comes from. It has a higher priority. It's preferred in order of payment, not necessarily it's preferred as in it's a more attractive investment. Another thing I want to mention is that as we move into our valuation models, one of the things we're going to assume is that stocks pay dividends annually. This is true for some stocks, but not all stocks. Remember when we did bonds, we assumed that coupon payments were paid semi-annually. That was true for most bonds. However, stocks are different. Some will pay dividends quarterly, some will pay dividends semi-annually, some will pay dividends annually. Now, it might be better to try to figure out which is most common, and that's going to be quarterly dividends. Most companies that pay dividends do so quarterly. That may seem like a more realistic assumption. However, from a practical perspective, changing to quarterly dividends versus annual is not going to make a big difference in our final result. If you remember when we talked about valuing stocks, we said it was so much more difficult. There's so many more assumptions and estimates that go in. We have to recognize that our final answer is not going to be real precise anyway. So our annual dividend assumption here is a little bit of a simplifying assumption. It's not going to make a big difference in our final result. It's going to make the calculations a lot easier though, so that's why we want to do that. Another assumption that we're going to make, and again, this is just a simplifying process designed to make our calculations a little bit easier, is we always assume that the current dividend, which we label D sub 0 or D0, has just been paid. If we buy the stock today, we don't get the current dividend. We have to wait 1 year to get next year's dividend, which is D1. So when we value a stock, we assume we don't get the current dividend. Our first dividend we're going to receive is 1 year from today, and that is going to be next year's dividend, or D1. Again, how realistic is that? It's not. Sometimes you'll buy a stock 5 days before a dividend. Sometimes you'll buy it 3 months before a dividend. It can vary a lot depending on just when you buy stock. People buy and sell stocks every day, so it's not always going to be 1 year before the next dividend. However, again, as I mentioned before, valuing stocks requires lots of estimates. It's not a precise process. Our final answer may come out looking like it's precise, $15.26 or $38.93 for a value. But in reality, if we come up with $38.93, that means the stock's probably worth somewhere between the mid 30s and low 40s for a price. We don't know exactly what it is because we've got lots of assumptions that go in there. This simplifying assumption will make the math of the valuation process a lot easier, and it's not going to distort our final answer very much. So that's both of these simplifying assumptions are just tools to make our life a little bit easier, and within the normal margin of error, they're not going to distort our answer very much. So that's why we like to use them. Next, we're going to walk through several valuation examples. I'm not going to include those in the PowerPoint slides here, but let me just say if you go through the guided tutorials, maybe you've already done so, walk through the videos, you'll see several valuation examples walking through how to apply the no growth model, how to apply the constant growth model, and how to apply the non-constant or supernormal growth model. Strongly encourage you to pay attention to those and make sure you're comfortable with those calculations. You're going to see them on the exam. You've got to be able to walk through those calculation processes, understand what's going on. So by the time you end this chapter, go through all those guided tutorials, the videos, the online text, homework, make sure you're comfortable with calculating the constant growth model, the no growth model, and the non-constant or supernormal growth models. Another thing we want to talk about is par versus book versus market value. Now we talked about book value a little bit earlier in chapter 2 when we did financial statement analysis. When we talk about bond valuation or valuation of preferred stock, you'll see par value come in. But what we're looking at here is common stock. So we want to talk about par versus book versus market value for common stock. Let's start with par value. Par value is essentially a meaningless number associated with common stock. It is technically the stated value of a common stock that was initially designed as a minimum investment at the time the stock was issued. So for example, a company could set a par value of $5. That means that when the company has their initial public offering, they've got to sell it for at least $5 or higher. If for some reason the initial public offering sold the stock for $2 per share, then investors owning the stock would technically be liable for the difference between that par value and the initial $2 that the company raised. Limited liability is one of the attractive features associated with common stock, and so companies don't want to have any situation where investors are liable for more than their investment into the company. Easiest way to do that is make the par value very low. Par value is typically set under $1. Par value 1 cent, 1/100th of a cent, or quite frequently most companies now will just say no par value. So par value theoretically has a meaning, but for practical purposes, par value is a meaningless number. It's not very important when it comes to common stock. Now it is important for bonds. It is important for preferred stock because usually dividends are a function of par value for preferred stock. But when we get to common stock, typically par value is a meaningless number. And again, most companies won't even have a par value on their common stock. Book value is a much more important number, still not the most important, but much more valuable than par value. Book value represents the accounting value of the common stock, and it's taken from the balance sheet. If you remember back in chapter 2, our financial statement analysis, we said assets equals liabilities plus owner's equity. That was the foundation of the balance sheet. The owner's equity represents the stockholder's interest in the company. Now, typically we'll express that as a per share value. So we take that owner's equity divided by the number of shares outstanding, and that gives us the book value. Also, if you remember back in Chapter 2 when we talked about balance sheet and book value, we said that the book value typically understates the true value of the company. Several reasons for that. One, it's based on historical cost, less accumulated depreciation, not what the assets are really worth. So if you think of maybe land that was purchased 50 years ago, that's going to be understated in its value on the financial statements on the balance sheet. Another thing to think about is companies that develop significant brand names. Those brand names have incredible value to the company, but they're typically not stated on the balance sheet. And there are some other intangible assets like patents and copyrights and things like that that might not be fully represented on the balance sheet. Final thing to think about is just, what is an asset worth? Well, it's worth what you can do with it. So if you look at a company like Coca-Cola that purchases some factory equipment, that company or that factory equipment is probably worth a lot more to Coca-Cola than what they paid for it. Otherwise they wouldn't have went out and bought it. But instead, they're going to use that equipment to generate cash flows through their normal business operations. That's what sets the value for what those assets are worth, is what can regenerate from them. So book value tends to understate a firm's true value. Most companies have a book value that is greater than 1. Quite often you'll see those book values be somewhere between 2 and 3. Sometimes you'll see them be significantly higher. Occasionally you'll see them be less than 1. Doesn't happen very often, but occasionally book values will be less than 1. But most often probably somewhere in the 2 to 3 range. Pretty common market value to book value ratios, which tells us that the book value significantly understates the real value of the firm's assets. Market value is the best measure of a stock's true value. Essentially, it's the price people are willing to buy and sell the shares for. Market price or market value is also the most current measure. Par value is set when the stock is initially issued, never changes. Book value gets updated quarterly as companies come out with new quarterly balance sheets. Market value is constantly updated. Every time the markets are open, stock prices are going up, going down, and that's reflecting investors' best outlook as to what the stock is worth. So market value is always the most current, up-to-date measure of what a stock is worth. Market value can change dramatically, but that's going to be based on new information coming out. So our market value is our best measure of what a stock is worth. Anytime you're curious about the market value, the easiest way to do that is hop online, any number of places you can look. Yahoo Finance is one of my favorite sources, but CNBC.com, Microsoft Money or MSN Money has information on stock prices, tons of other places. MarketWatch.com, TheStreet.com, individual brokers. You can always get a current up-to-date value of what a stock is worth, get that current market price on a per share basis. Next thing I want to talk about is, what do you get when you buy common stock? What rights are associated with common stock? The first and most important is the right to residual income. It's the primary reason people own shares of common stock. For example, if you buy 100 shares of Apple, and since Apple stock at the time I'm recording this audio is probably right around $600 per share, I'm guessing most of us aren't going to be rushing out and buying 100 shares right now. But if you did have the money and you wanted to go out and buy 100 shares of Apple stock, why are you buying that? Well, you're buying it because you think it's going to increase in value. Why would it increase in value? Because owning a piece of Apple becomes more important. Not so you can have bragging rights, so you can run and tell your friends, hey, I own a piece of Apple. That's not what's important. But instead is you own a piece of Apple, you own a share, then you own a right to every piece, to a little piece of every dollar of income that they make. So your share represents a claim against Apple's earnings, the profits that they make. Now, once Apple starts paying some of those profits out as dividends, then you're going to be entitled to those dividends. But the right to residual income is not necessarily the right to dividends. Companies can choose to pay dividends, or they can choose to reinvest that money into the company. And that's what Apple's done for a long time, is not pay dividends to its shareholders, but instead reinvest that money into the company so it can grow a little bit faster and create higher cash flows. Now, a lot of times companies will not pay dividends initially as they're in high growth stages, but once they start generating enough cash that they no longer have good reinvestment opportunities, that's when they'll start paying dividends out. Now, what about the income the company makes before it starts paying dividends? Does that belong to you? Technically, yes, and that will show up in the balance sheet under the retained earnings category. So when you buy a stock, the reason you're buying it is because you want to own a piece of the profits that the company is going to generate. And owning stock gives you a claim against that per share basis of the company's earnings. Now, a lot of companies may have millions, hundreds of millions, or even billions of shares outstanding. So each share gives you just a very small slice of the profits. But some companies make billions of dollars a share as well. So you want to look at your earnings per share as a measure of how much of that income belongs to you. Another aspect that you get with common stock is the right to control. Now, a lot of textbooks leave the quotes out there, and you may notice on this PowerPoint slide that when I say the right to control, I put the word control in quotes. Honestly, I think if you're buying stock, unless you're a large institutional investor where you're going to be buying 5-10% of the company, it's not very realistic to think of control. Your control gives you a voting share, a voting right on the board of directors. Doesn't mean you get to directly influence the company. You don't get to go in and say, hey, Walmart, I think you're charging too much for bananas in your store. Let's lower the price of that. It doesn't give you the right to say, hey, Exxon, I'm a shareholder. I think we need to start developing more natural gas production. Instead, those are decisions made by the board of directors and management. What you get the right on is to elect the board of directors. However, remember, many companies have hundreds of millions, billions of shares outstanding. So if you own 100 shares and there are a billion shares outstanding, how much does your individual vote matter? To carry this further, some companies don't even give you that ability. For example, one of the big issues with the recent Facebook IPO is that the shares of stock are non-voting shares. So you don't get to elect the board of directors. You don't get to influence Facebook. That's going to be held by the CEO, Mark Zuckerberg, who is in charge of Facebook. And there are other companies out there that have non-voting shares as well. So in many cases, your right to control may not even exist. The right to transfer ownership. What if you don't like the way the company is being running? You can sell your shares. What if you do like the way the company is being run, but you think the stock price has gone up quite a bit? You can sell your shares. So you can sell your shares, transfer ownership at any time you want by selling them to other investors in the financial markets. Now the price you're going to get is the current market price, and that's set by kind of a consensus supply and demand, what investors are willing to pay and sell. No one person sets the market price for stock. Instead, it's determined in the financial markets at kind of an equilibrium supply and demand price. But one of the rights associated with common stock is at any point in time you can sell your shares. Remember, common stock doesn't have a maturity date, so anytime you want to cash out your investment, the way to do that is to sell shares to somebody else. And so you would do that through a broker. Maybe it's an E-Trade, maybe it's a TD Ameritrade, maybe it's Fidelity, maybe it's Edward Jones, whoever your broker happens to be. You tell them, I want to sell these shares, And there are couple ways you can do that. You can do a market order, which just says go out and sell my shares at the current market price, or you can use what are called limit and stop orders. And we're not going to go into those detail in this class, but for example, if I had stock and it was currently trading for 30, and I said, you know what, I want to sell it at 35, I could enter a limit order that says sell this stock if it hits 35. Now, because the stock's currently trading at 30, my broker's not going to be able to sell it for 35. But if the stock price keeps going up, once it hits 35, then my broker will sell it. So the right to transfer ownership is a common feature associated with common stock. The right to information. If you own shares of common stock, one of the things you have is the right to audited financial statements regarding that company. Companies are very good about providing a lot of information to shareholders. A lot of that is provided in their investor relations page on their corporate web page, and those are going to include things like filings with the SEC. A lot of times they may even have other presentations or frequently asked questions, things like that. And again, audited financial statements are available for all companies. Finally, limited liability, which is something we discussed back in Chapter 1. Limited liability just refers to the fact that you can't lose more than your initial investment. Remember, it doesn't mean you can't lose money. It doesn't mean you can't lose your entire initial investment. It just means you can't lose more than that. So if you buy a stock for $50 a share, worst case scenario is the stock goes to zero. It can't go to a negative value and you owe more money. Last topic we're going to talk about in Chapter 5 on stocks is market efficiency. And I've got a separate handout on market efficiency available, as well as some PowerPoint slides on market efficiency. So I'm not going to talk about those here, but instead we're going to have a separate handout and PowerPoint slides that go into much more detail on market efficiency.